Good to see you in the room. We've done one or two greetings this morning. Edward, Manoj, Mr. C, Panon High. Good to see you there, Sue. And so I think we'll get started in just a moment. That's brilliant. That's brilliant. Right, guys. Well, what we're going to do this morning, we're going to come back to a theme which has really stayed with me throughout my trading career. And that is that I don't like to do what other people do. And I'm a bit like that in most things that I get involved in. And particularly in the markets, because there's a frightful statistic, and that is that the majority of traders don't make money. And the majority of traders do lots of things that the majority of other traders do. And indeed, I was talking to a guy who worked in the city just over the weekend, and he looks after a group of traders. And on that group of traders, he's got a number that barely survive. And these are institutional traders, I have to say, bank traders. And he's got, a number that are not making money. And he's got just one trader who makes the lion's share of their profit. Now, when it comes to retail trading, then the statistics do show that the majority of traders do actually lose money. And indeed, you can, whenever you go to open an account, particularly with a US broker, they have to disclose how many traders are profitable and how many are not. And it's really quite an instructive thing to look at, because it clearly shows that a lot of traders do not actually survive, and they just don't make money. So it's true of institutional traders, it's true of retail traders. And what we find is that because we're human beings, we are crowd following creatures. We like to be with other people. We tend to go on holiday to where lots of other people go, and we will sort of read up on TripAdvisor, and we'll sort of take account of what the majority are talking about. We gravitate to people. We join clubs. We like to go out in the evening to places where there are other people doing like things. It's rather like birds of a feather flock together. And that's one of the problems with trading, because we tend to do a lot of follow my leader. And we're going to be looking at one or two charts today where we've got a lot of consensus going on, and that consensus can possibly not be quite the right thing. We look first of all then at this chart of cable, pound against the dollar. Well, what do you reckon is one of the strongest looking currencies in terms of fundamentals at the moment? Well, I guess it could well be that the British pound is right up there. And it's flavour of the month. It's flavour of the month. The UK economy, from the figures that we have seen coming out over the last few months, have been pretty good. They've been very good. They're showing that we got a booming economy, or at least the recession. Is it over? Well, the figures are telling us that it's really coming on quite nicely, and we shouldn't be too worried about it, and that we've got growth in the UK, growth, this phenomena that has become something that Western governments are totally addicted to. They must have growth at all costs, at all costs. And of course, the all costs are being what is going on with QE and this general shift of wealth towards the very rich from the middle classes. I don't want to get too hung up on that because it's a somewhat different story. But the British pound then seems to be doing very, very, very well indeed. And if I bring across, bear with me a second, because I just need to bring up chart. We'll look at this one. It's always a week in arrears. So whatever figures we get published, then it's always a week, at least a week out of date. So we've got to keep that in mind, but it's for the previous week. So consequently, we're not really going to be using this as a short-term timing method. We go to the charts for that when this tells us that just maybe we could be due something of a change, something of a reversal in trend. But what it's very, very useful for is timing longer-term trades. Now, at the moment, what this is showing us, I've got this clicked on leveraged money. There are various other categories. But it's the leveraged money which is the most instructive one, because these are the traders who will have to get out if the market goes against them. And if they have to get out, the chances are that the market will move really quite nicely with a change of trend. So a point of explanation then, first of all, we are looking at these histograms. The blue histogram, you can see there, that's those who are long the GBP. And then the orange ones, well, they're shorts. And then the green, this little green line, is the aggregate position. Okay, that's the average more. Now, you may well be familiar with open interest charts, and open interest charts will tell us what this overall position is. So there's a fair bit of open interest out there, meaning that there are a lot of traders who are positioned. And over a period of time, we've got a large long position that has been built up. And in fact, it's been getting greater and greater and greater and greater. And that goes back, you can see, it runs back until November last year. Now, the number of shorts in the market has been overall flat to gradually declining. So what this means effectively is that the majority have got a lot of long positions actually open in the market. They haven't been closed. They are waiting to be closed, and the majority of traders then have got optimism that the GBP will go higher so that clearly they can sell out at a profit. So there are a lot of longs in the market, a lot of long open contracts just sitting there waiting to be closed. Now, why does a trader close a contract? Well, that trader is going to close it for one of two reasons. Either it's gone very nicely in that trader's favor, and he or she is sitting on a whacking profit, and the time comes when they think, well, we better take the profit. Now, the other situation, of course, is that the market just might come against them. And if it comes against them, then they're going to be sitting on a loss. And of course, sooner or later it's going to hit their stop loss, or it's going to hit their pain threshold, and they're going to close it out. So you've got those two situations, those two opposing times when traders are going to close these positions. So if we just consider that for a minute, then we've got this big long position in the market in cable. Now, let's move that out of the way for a minute and take a look at the actual chart of what is going on. Daily chart, what we can see is the price has been moving up. So over here from the left to the right, it's been in an uptrend. And for a period of time, those longs have been absolutely right. They've been absolutely right. But what we so often find is that we can get a big imbalance in the market. That's exactly what we've got in cable. We've got a massive number of longs. And I reckon that we're at a critical point. We're at a critical point at the moment because it went to a new high, as we can see. It didn't quite make 170. It's now moved off in a classic little ABC move, and there's a level that is going to need to be maintained, and that level is the level of the low, the recent low of 167. If price would have dropped down below there, then I wouldn't be at all surprised that we could well find that those heavy longs in the market, well, they could flip round. It's entirely possible that they might start to find that their stops are going to be hit and they need to sell out. So whenever I see a commitment of traders report which is showing there's a big imbalance on one side of the market, that market is just waiting for an upset. It's just waiting for something to change the situation from the consensus that everyone believes in. The whole thing could turn quite rapidly, and if and when it does, then we're going to see fireworks. Right, so that's taken a little glance at the British pound. Now I'm just going to flip over to another one for a moment, which is has been a real good mover in both directions. We can see that it's been pretty high. And then it tanked on down, and a lot of people are saying, oh well, it's China. It's China where the Australians were selling an awful lot of aggregates, etc. And when the gold price was really, really strong, they were getting a lot of money for their gold, and that's what held it up. And then all of a sudden, China came along, and gold started to come off, and then we get this tumble right the way on down. And it's been sort of rallying up a little bit since then. So let's just bring across this commitment of traders report and have a look at it for the Australian dollar. And what we can see is that, again, there have been a lot of longs in the Australian dollar, a lot of longs. And if you look at the date, that's January, around about the 21st. So if we just flip back to around about the 14th of January, we've got this sort of massive number of longs in the market. Okay. Now, let's just pop that down for a moment and have a look at this. And let's just put a date on this. That's a 24th of the 1st. Let's just flip it back a little bit and let's put a line. At around about this time, this is when the market, okay, had decided that it was ready for a turn. And turn it did. And turn it did. It turned in a big way, and we then saw it absolutely take off and move up strongly. Right, Mr. C. Sorry, we see dealer now. I'm not sure I understood that directly, but it's fine. Of course, I do understand it. Yeah. Put this over. Right. Sorry about that. What we're looking at then is that around about the middle to the end of January, we've got this massive position, okay, which is wrongly positioned. Yeah, thanks for pointing that out, Mr. C. And what that was suggesting then, that the majority were on the wrong side of the market. We can see that if we follow this forward, at around about this position, we get a flip. It flipped over. And it flipped over in March. So if we go back to see what was going on in March, we're at around about this position. Let's put another line on. So the market around about this time had cottoned on to the fact that, yeah, this was actually going on up. And going on up is exactly what it's been doing. Until it's got to this sort of level. And where we are right now, well, what is that COT doing? We can see now that that flip over has meant that we've got an extreme number of longs in the market, and the number of shorts has remained reasonably static, although that has started to increase a wee bit. The overall open interest has actually gone up. So the situation right now then is suggesting that just maybe, because we've got a high number of longs in the market, then we might well find that they've got it wrong. And the market is ready to start to take something of a tumble. Now, the Australian dollar does work very well with this, very, very well indeed. And it's just a question then of glancing at this once a week, just to see what is going on. And then we can sort of form an opinion of which way this market just might want to be headed. So on the basis that we've got a large number of longs in this market, a relatively short number of shorts, and applying a little bit of contra-think to it, it suggests that just maybe if this level where this line is running across, if this level gets broken, there will need to be a lot of longs, which will be well and truly stale. They'll find out their stops are being hit, and that could well fuel a major move on the downside. So that's the way that we're looking at this little lot. Now let's look at another one. Let's go to reported gain. And what we can look at, as you can see, we've got the majors here. The yen, which no great surprise that the majority are still short. And what was really quite interesting, when the disparity between the two was at its greatest back there in December, where we've got the maximum number of shorts, that, if we just take a little glance at it, there we are, back in December, was where the market, the US dollar part of the market, went into decline. Now, let's just go back to this for a minute, because the base currency has actually switched around from what we were looking at previously. So there it is, that's December, where we've got the maximum number of people short the Japanese yen, so that implies that they are long the US dollar. And that was really entirely the wrong time to be long the US dollar against Japanese yen. The whole thing has started to unwind somewhat now. We've still got the majority who are assuming that this chart is going to move up. US dollar is going to be stronger than a weak Japanese yen. But of course, that is no foregone conclusion at all. Right, now let's look at another one. Just look at Swiss franc for a moment. Swiss franc, then what has it shown us? It's shown us that if we go back to where we've got a pretty big disparity between the two, and Mr. C, this might possibly get to it. So we've got a massive number here of longs in the market on the Swiss franc. Okay? So over that period of time, between those two histograms, we've got a large number of longs on the Swiss and a relatively small number of shorts. So the majority of traders then, they are positioned long the Swiss franc, which suggests that they are short the US dollar. So let's just go and take a look at the chart. Consequently short the US dollar against it, around about here where that vertical line is, and that was exactly the time when they should have been the other way round. Okay, this is absolutely right, George. It's a contrarian sentiment, and had those traders not been positioned the way that they were, then they wouldn't have been caught out. But they were caught out, and there was a strong rally that moved on up. Okay. Now, if we look further along, relatively recently, we get the flip. It's flipped. So we've got the longs who have got the majority in the market. It then has flipped round the other way, so that right now we've got the shorts in the market, short the Swiss, which implies that they are long the US dollar. And we've had this flip over just over here, and that's now starting to suggest that just maybe this move up has been a bit mature, is now getting a bit mature, and might be ready for a bit of a rollover. In actual fact, it's picked up a very neat little false break reversal level also, and it's just under a major round number. So combination of these things can start to build up a bit of a picture. And that's the key thing, that when you've got everybody on one side of the trade, it's a very vulnerable market to a major reversal flipping back in the opposite direction. Now, you can do this with not only currencies, you can do much the same sort of exercise. You can do it with all of the futures markets which are traded, and you can certainly do it with the likes of precious metals. Let's just have a quick look and see what gold is doing. Right, so look at gold. Again, let's look at the daily, just get the longer term perspective. And what we've had this year, then we've had this very, very good run up from 1200 region up to nearly 1400, couple of $100. And then it just caved in. Now let's just look at this example just to see, and we might be able to get a slightly clearer perspective on it. Let me just see if we can get the right one displaying and the right way around. Now, the way that these are shown is a little bit different, and the one that I use on this is managed money. Now we've got sort of producers, we've got swap dealers, other reportables, etc. But it's the managed money, which again is something of a proxy for leveraged money, which regrettably money managers don't really do a particularly brilliant job. So yeah, this is gold that we're looking at. Okay. Now, Mr. C, we don't necessarily have to see the flip over. We're just looking, number one, for a big imbalance. Okay. So what we're looking for is where there are an awful lot of traders who are either long or indeed short. So let's just look at this time. This was, excuse me, on the 8th of March. We can see this big imbalance purely because the histogram is at its highest. It was building up, and the number of shorts are at an absolute minimum. So there's a big imbalance in the market. Now, we've got no flip over here. We've got no flip over at all. And that's really on gold at the moment. It's the nature of the market. It's the nature of the market. So if we just look then around March, the 18th of March, or just a little bit before, we've had this big run up. But at the highs, that's just where there were the majority of longs in the market. So there was a massive imbalance then between the longs and the short. The crowd, the herd sort of mentality of buying gold, because everyone else is buying gold, and it's like a snowball effect. It went up to a high, and it then caved in. It caved in under the weight of the number of long contracts out there that just had to be closed at some point. Sorry, the number of contracts which were just putting this massive imbalance into the market. Okay, so you get this massive number of longs. There are just so many longs in the market, and at some point what has to happen is that those who made a lot of profit along the way have got to close their positions, because they're sitting on so much profit. And then once it starts to break the trend, and we just define the trend so simply by looking at a succession of higher highs and higher lows, once price then starts to break any of the previous higher lows, which is just about there as price comes down, then you start to get people's stocks getting hit, and away they go. So that's really the nature of what happens with all of these little mini bubbles that we get from trends that start off from extremes. And that's the real key. It starts off from extreme levels, and then it moves up through a sort of a neutral level up to a real extreme on exactly the other side, on the long side. And we can often see it from the Commitment of Traders report, which can't lie. It tells us exactly what is going on with the number of traders in the market. And we can get other little indicators along the way, such as harmonic software just picking up a full straight reversal level. And then what happens? It reverses. We've then got another opportunity to close out our longs, take a short positions, and just run it until such time as the market looks as if it's going to reverse. Now, what about the current position? Well, let's just have a little glance at this. This is to the wrong game. Let's go back to managed money. And, well, what we've actually got at the moment in gold, we've still got an imbalance. The imbalance is not as great as it has been recently, but that is where the imbalance was at its greatest recently. So if we just look at the date on that one, okay, we're looking early May, and early May is just when all of those longs got it wrong, because we've had it tumble on back down really over the last couple of weeks. So it's not going to be a foolproof tool that we can use time and time again. But what it can give us, certainly for longer term trades, it can give us the heads up on when just something pretty dramatic could be ready to actually happen in the market. Now, let's just take a look at copper, because anyone who's trading Forex should be prepared to trade both gold, silver, and copper. Particularly in this current climate where we've got this massive encouragement to get growth out of the markets at all costs. So there we are. We've got market which has gone up, it's gone down, and it's gone up. Let's just bring the COT across. We've got it for copper, we've got it on managed money. Let's just put it up full screen for a moment. And we've actually got several flips on this one, as you can see. Over on the left-hand side, we've got this area where the shorts were dominant, okay? Then flipped over, and then the longs became dominant. And at that point there, early January, that's where we've got the big imbalance between the two. Let's just see what was going on there in January. Well, that was the big imbalance with the longs having had this run up. And unfortunately, they were wrong. Price actually came off. It came down. We look forward then a little way to where it flipped over, to where the shorts were dominant. Okay. That was in February. And rather unfortunately, it rallied up at that point, continued on down, and then if we look in March, where we've got then a large number of shorts in this market. Okay. Now the shorts got it right for a period of time. Then we get the big imbalance where we can see that the histogram is higher than it's been. Massive number of shorts in the market. And that's just when, again, they got it wrong and the market rallied. So there'll be profit takers down there. There'll be those who are massively short, ignoring what the candles are telling us, and they will then have to cover their positions and buy, cover their shorts and buy, and then we get a pretty strong move on up. Well, where are we now? We just roll this along, and what we've actually got is a relatively high long position in the market. Not massive, not as massive as it was. So, there's still scope for this one to go higher, but the imbalance is building up. It's building up. So it's well worth just keeping an eye on it and watching then what is going on with price action, because price action is the final arbiter of everything. It's following the trend. The trend at the moment is going up, and we'll know that the trend's going to change when, for instance, that last higher low gets taken out by price moving lower. Right. Okay, guys. That's just taking a little glance at some of those sort of major imbalances that have been building up in the market. And it's at the extremes that things get the most interesting. It's where the majority think that a market is going to keep moving with the trend. We're always told that the trend is your friend. Well, it is until it decides to change. And very often things like the COT report can just give us the heads up when that's most likely to happen. Now, I just want to show another little tool that we use. Yeah, absolutely, Pat. Yeah. I just look at it once a week. It comes out. It's published on a Tuesday. Okay, it's published on it's published on a Friday up to the previous Tuesday. And having said a Tuesday, the CME are a little bit slow on updating their histograms. So look at it on a Tuesday, and that's when you'll see it updated. And it will be, the numbers will be good for the previous week. So whenever you've got a big imbalance, that's really what I mean. You just make a little note. You might want to just sort of print something off, put it on a post-it note on the PC, and just take a glance at it every now and again. When you see it really, really building up, be very, very careful about wanting to go further long when there are a massive number of longs in the market. I want to be starting to look in the opposite direction. Now, having mentioned what's going on with cable, let's just look at another little tool that we use. We use harmonics, and I use extremes of volume and the activity that goes on. We've got a nice little tool. It works in TradeStation. It works in MT4, which is a very, I guess that, tell me, can I just ask you guys, how many of you use MT4 for your charts? Yeah. Oh, right. Well, actually, we should really be looking at this on MT4 right now. Yeah. And how many TradeStation? So, Edward, you're clearly using something else. Yeah, cool. Right, well, I think we've got the majority in MT4. Bear with me. Let's have MT4. Let's see what we can see on MT4. Right, half a mo. Let me bring up my MT4. Right, well, let's just do one or two bits and pieces. Right, well, what have we got? Well, we're just looking at the euro on there. Now, what I want to do, let's bring up a whole series of charts. 12. Right, there we go. Got a whole series of charts. So let's just look at these in just a little bit of detail, and you can see what's going on. First of all, we were mentioning gold, by the way. This is the gold chart, and we put a number of things on. We've got our value finder, which is giving us an indication of overbought, oversold. We've also got the harmonic fib finder, and this fib finder is picking out some of the key Fibonacci levels, which just might also be harmonic levels. We've got a color trend, so that we've got a broad definition of trend, which changes color with the trend. We've got a couple of moving averages, which are very, very, very useful for keeping us in a trade. And then we've got these different colors. Now, these different colors of the actual bars themselves give us the heads up as to how much activity there is within that particular candle or day, or it might just be a 15-minute candle, which is actually operating at the moment. And consequently, Where we've got a lot of activity highlighted there by a red, then we know that we need to sit up and take notice. Now, there's a little bit of interpretation that needs to go on, and there's a little bit of theory attached to this, but it's a very, very useful tool. And where we've got very light activity going on, then we can start to think that, well, just maybe right at the very top of this market, where we've got a light activity day, then there's no momentum there. There aren't many traders getting involved in pushing this higher. And then consequently, it moved on down, picks up one of the false break reversal levels, and as we can see, the trend moved on down. Right, so that's a little roundup of all the bits and pieces that we will put on a chart. Now, if I come back to where we were looking at the British pound, we've had one or two nice little indications. And rocket science, you can see, bring this where we are. We had a high, okay, picked up a very, very clear harmonic crab level. Price then came on down, and we use a little bit of wave theory. And a little bit of wave theory tells us that prices will often go in a zigzag zig. Now, a zigzag zig is an ABC move. And this just happened to be an A move moving down, a B moving up, and then a C moving down. And we got this purely by drawing a simple red line. And that simple red line, as soon as it was broken, that was the signal to us to sell it. We had a lot of activity on the way up. There was a nice little move on the way up. That activity then just tailed off. We had the right candles, and that told us that this was going to move on down. It actually tell us that it might have moved a little bit lower than it did. And right now, I'm watching this price action very, very carefully, because what we actually haven't got, is a really strong follow through on the upside. And we've got a critical day today. Today is a day that has moved higher. So that's Monday's trading. Ignore that little bit of Sunday trading. In fact, we could put the two together and then compare it to what was going on Friday. What we've actually got is that Monday and Sunday forms an harami. Now, we had a little harami break on cable earlier this morning. And so what I'm looking at now is how this is going to end up today. So it's hovering around 167.50. If it were to move lower than yesterday, then the odds are going to be very, very, very high indeed that we will get a move down, and that move will go to, at the very, very least, 167 to start with, and I've got projected target levels considerably lower than that, if that were to happen. And all of that is also following up on what we're looking at commitment of traders reports, where there are too many people long in this market. It could just all cave in under its own weight. Now, all of this, yeah, we do supply all of this, in fact, DB, and we've got available the automatic fib finder, comes as part of the harmonic wave trader package, and the candles that you're actually looking at there briefly, they are based on the extreme trader. Combination of the two together is a very useful little package. So I'll just leave you with that thought at the moment, but look at those commitment to traders reports. They can very often give you the heads up. And if you can get yourselves in the frame of mind where you are doing the opposite to what the majority are doing, then you are putting the odds in favor of becoming and being and maintaining profitability. So Yeah, if you'd like any more information on any of this, if you want a sort of little personal one-to-one session where I could just show you in a little bit more detail, harmonic wave trader, extreme trader, etc., don't hesitate. Just drop me an email. Be only too pleased to keep in contact with you. You can do that through support. I just put this up, support at Click Events. .co.uk. Right, if you've not got any more questions, I think we've more or less reached the allotted time, and I know that FX Street quite often have to remind me that I'm running a bit close to time. But if you've not got any further questions right now, then I'll close. Been good to be with you, and hope to be with you again at the start of next month. Bye for now.